Location, location, location is one of the most popular phrases in all of real estate, and with a good reason. The location of your investment can be the make or break between earning a profit or suffering a loss. In today's video, I'm going to show you the list of criteria that savvy investors use when deciding where to invest in multifamily real estate. So first, let's talk about market research. You've got to really look at and conduct thorough market research, identifying the location that has the greatest strength for your multifamily investment potential. Now, how do we do that? We want to look at larger scale MSAs, meaning like you want to be in communities that are not 5,000 people, but 50,000, 100,000, 200,000, million, right? We invest in major metropolitan areas. Tampa MSA, where you have multiple millions of people. You have Atlanta, where we are, where multiple millions of people. And then we also are in smaller submarket MSAs where they have 150, 250,000 people. And again, that's still a lot of people. So what you want to look at for that perspective is you want to see people migrating in migration, not out migration. And then the other piece of that, you want to look at the diversity of the employment base that's there. Not that it's just a single employer. Like there's some people I've known that have invested by a town where there's a military base. Well, in the past, not recently, that they closed the military base, the town is like in trouble. Or you have a singular manufacturing company. Like that happened in North Carolina and up north in a number of areas where the manufacturing place closed and that, hurt the town. So you want to look for a diversification of employment. And also the other thing you want to look at is net in-migration for jobs. Are companies moving there? That's totally critical. So now once you allocate and find those things, now you begin to look at within the overall market itself and what we call submarkets, what presents the best potential, right? Because there are certain pockets and areas within the town that have greater demand for rental property because of their proximity to jobs that are likely to fit the profile of the people living in our community. If you notice as we're talking through some of these things, it's a very dialed in approach. We're not just wildly buying something in any location. We're looking specifically for a quality asset in a quality location that serves the needs of people that are going to be in that area. And doing so really brings great value because now you're going to get more people looking to want to stay and live in your community. Economic factors is the next area you want to look at, right? You want to look at not only do you have these great indicators that we've spoken about with in-migration of people, in-migration of jobs, but you also want to look at what kind of jobs are being built, if you will, or what kind of companies are moving in. And again, you have to be able to understand that because again, different jobs pay different money and they have different tenants, right? So a lot of times we have what we would call workforce housing, meaning people that are entry-level professional as well as blue-collar individuals, typically C plus, B plus properties that we own. And so if you've got Facebook coming in and they're doing engineering jobs at $150,000, oftentimes that person is looking at more of an A-class property. But again, we also provide that with our communities, we're looking at, we want to be lower priced, if you will, the competitors so we can really attract quality people. And so looking at the income for the jobs in the area, looking at your specific and immediate surroundings of your apartment complex to see what is the average income in that 1 mile, 3 mile, 5 mile radius around you. Again, like if you're looking to attract somebody that is, in that $60,000 range kind of thing, and then yet everybody in the surrounding community is making $24,000, it's probably an indicator that there's something out of alignment. So you want to make sure you have proper alignment. The other piece of it is you want to make sure that your rents possess the affordability for the area that you're in. And so now, and there's a little bit of a misleading factor that you have to look at because a lot of times many people would, you look at certain areas that we invest in major markets and, the rent may be, as an example, $1,200 a month. And that's what the rent is going for in that area. When you look at the average income it may be a little bit lower, but what you have going on is where the cost of rent has risen in these major markets. So you still want to make sure that you're hitting an affordability range. I mean, people are not able to pay 50% of their income for rent. It's just not a reality. But again, the traditional metric is below 30%. If you're enjoying this video, make sure give it a like and subscribe to my channel. Next, we want to talk about supply and demand. And this is really significant in being able to evaluate, do you have too much supply of housing? What is the demand? How does that correlate to the market you're looking at? The majority of the markets we operate in by design is where you have a shortage of supply and an ever-increasing demand. Again, think about some of the things we spoke on earlier. If you've got more people moving there and you've got more jobs coming, there's more demand. And then typically the properties we buy are built in the 70s, 80s, 90s, even the 2000s. And so those don't compete with new construction. When you build new construction units, they're typically Class A. And the reason for that is because the cost of construction today is so high, you can't build a 1980s product in today's environment. And so that presents a great opportunity for us, because now when we buy into a market, you can look at and evaluate the 4 or 5 immediate competitors in the area. And on a 1980s product, those are the 4 or 5 competitors that you have. They're not going to be somebody coming in down the street and building a competing product to match yours. And what I mean by that, let's just say, for example, a community we own here locally. It is a 86 built, wonderful B+ asset, beautiful location. You know, rents there are about $1,250. Premium units, $1,450 now. And you're not going to come in and have somebody build right down the street an A-class apartment and charge $1,450 for a 2-bedroom apartment. They're going to have to get probably upwards of $2,000 because of their cost. And so that's where, you know, supply and demand is a real critical factor. And then the other piece is on a macro level as a country, we're probably 3 to 5 million units short in terms of affordable housing. So what that does is it gives us easily another decade of overarching demand. And in Economics 101, shortage of supply, increasing demand is going to push price up. Next, let's talk about neighborhood. Neighborhood is so key. You want to look at the characteristics of the neighborhood. You know, I always, when going to look at a property, I go and stop at the gas station locally there. I go to the grocery store that's there, take a look at the shopping areas that are immediately there. That is really who your tenant is, right? So if you pull up at the, you know, in Florida, it's the Publix, maybe in Georgia, it could be Ingles or some of the other stores up there. That's who you see. That's your prospective tenant. You pull up at the gas station, you know, down the block. Again, same thing. What you want to look for is, you know, quality areas. You want to look for good school districts. You want to look for, we love to be able to be near schools or near churches. Those are oftentimes good characteristics that represent you're in a good school district. You've got quality people with the church or synagogue that's there. And realistically, you want to look for neighborhoods that have strong demand because of their location in proximity to jobs and travel. One of the things, just like as an example, understanding the market. We talked a little bit about this earlier, but like in Atlanta, one of the big things that happens there is you've got heavy traffic there's a loop around Atlanta called 285. And it's like, so you want to really make sure if you can avoid that, that's a real plus for people. So we've owned communities that are off of that path of the 285, but have connector arterial roads to the job areas where people can genuinely get to manufacturing, transportation, and those type of jobs within about 10 or 15 minutes on the, quote, back roads. That is a huge driver of demand because it represents a great opportunity for them not to have to be stuck in 45 minutes of traffic. And so realistically, those properties have always been historically, 94, 96, 98% occupied because of that demand factor. So it's very important, especially in today's environment. Look, 2023, where we're at right now, this is even more critical to be in the right location, in the right neighborhood, in either owning or buying new assets. And I'm shooting you straight, friends. There's people that have bought in the last 2 years that, it was a questionable or marginal neighborhood. They, as a result, are not hitting the numbers that they want to hit. And it's a difficulty for them right now to perform. And that's unfortunate, but, by not following some of the tried and true characteristics that are core to success in this business, when we enter into a time like this in this portion of the cycle of the market, it makes it more difficult for them. Okay, lastly, let's talk about emerging markets. So there's definitely benefits in emerging markets. And what I mean by that, it's an up and coming market. It's not maybe say a major MSA. There's secondary markets or tertiary markets. So a secondary market or tertiary market can be emerging, that it's really becoming a stronger market. And predominantly a lot of that is there's favorable conditions going on there, meaning more people are moving there. Oftentimes people are moving there for quality of life. We saw that in the pandemic where more people moved outside of the urban core because they wanted to be in a more open space, or even too, as we've entered into a period where there's more remote work opportunities, people have even moved to more traditionally tertiary markets because it's a better quality of life. And so when you look at that, there's the greater potential for those returns to escalate up because more positive things are happening in that market than it did historically. Now, the challenge also too is that, it may not have continued drive. If some of the driving forces behind it kind of fither out or peter out, if some of the driving forces behind it kind of fizzle out, then that can be a problem. So you do want to make sure in an emerging market situation that there's a core stickability, if you will, to what's going on there. And again, now we've done this as well. Even ourselves last year purchased probably 3 communities in what would be called emerging markets. They're just outside of major MSAs, but you have great manufacturing companies that have moved in there because they're able to acquire larger swaths of land for a cheaper price and actually pay a little bit lower wage to the employees because they've got a lower cost of living compared to a major MSA. And so, and quite frankly, the properties that we own in there are killing it. They're going past performance numbers because of exactly the reasons I'm sharing with you. So it can absolutely be a vital and great strategy for you to make real money. You just got to be dialed in on your approach. That's all I have for you today. And if you're interested in passively investing in multifamily real estate with me, click the link in the description of this video to join our investor club and be the first to learn about off-market investment opportunities. Thanks for watching, and we'll see you in the next video.